Welcome back. Tonight, I want to talk about the reasons for this crazy, wild gyrations in the volatility. We started the show out with it, and Liz Ann and Jim made some great points, and I agree with them. I think, number one, first and foremost, these robots, these programs, the algorithms, they have run amok. ETFs, they have run amok, too. The rebalancing is crazy. Then, of course, there's uncertainty. It's not just the Federal Reserve. It's just not the global economy. It's leadership in general. But also, I want to talk about Wall Street analysts. I mean, these guys, I don't know what happened to them. Case in point. Last Thursday, workday, you guys know it. I've talked about it a lot. I like it. We're in it. They posted an amazing earnings report. We're talking strong wins, both top and bottom line. And then they gave long-term earnings and margin guidance, both well ahead of Wall Street consensus. But the company did say that the current quarter would be slow, some business adjustments. No big deal. But Wall Street analysts like sheep, dramatically lowering their targets. Here's the thing. Even as they were heaping praise on the company, take a look at RBC. They talked about the fourth quarter. Then they talked about acceleration, win rates, the core financial pipeline. All of this is good stuff. Why did they go to an 83 target from 100? To me, it is absolutely crazy. They're not the only one. Northland Capital. Expectation payments will be closer to 100% from 110%. That's the kind of stuff you want to invest in. What did they do? They went from a target of 105. Now they think this is an $87 stock. They can't be serious, guys. FBR, Freeman Billings Ramsey. Wow, look at this. I find it impressive that the company was able to approach operating margins and break even. If you were impressed, why do you think it's a $90 stock? Before it was a $110 stock. This is why we've got volatility in the market, because of this kind of stuff. Finally, Needham, look at this one. The firm believes that the underlying fundamentals are not only healthy, but it's improving. The company expects the company to cross profitability in fiscal year 17 on a permanent basis. So, sounds like I should buy it. But why? Target now 92. It was once 107. This is a serious issue. It's helping to roil the market. In my mind, it's a rookie investment mistake. However, it's perpetuated by so-called experts. Want to bring back Liz Ann Sonders. She's still with me. Liz Ann, you brought this up a little bit in the beginning. Wall Street and how it's sort of, I don't know. It's one thing with the high-frequency guys. I understand that's their business model. But what about these old-school firms that have been around for a long time sort of perpetuating this nonsense too?
Well, I'm not going to criticize other analysts. I think analysts do a perfectly valuable job for those investors that want to follow fundamental analysts, traditional analysts. I can speak for our company. We don't have analysts in the traditional sense of Wall Street. We rate 3,000 stocks, and we rate them with pretty simple A, B, C, D, and F grades. So you don't really get the whim of the analysts trying to chase or run away from momentum. But there's still good analysts on Wall Street.
I'm not trying to diss them either. Honestly, listen, I'm an analyst too, so I understand it's hard. It's a difficult job, but I think it's being made more difficult when you say this is a company that's doing great, but I think it should be a $20 lower than it was just 24 hours ago. I think it makes the job even harder, and it certainly makes it more complicated for the average investor.
It does, and unfortunately, a lot of these analysts do have to do things like set price targets, and as do many strategists on Wall Street. In fact, most strategists on Wall Street do the year-end price target. We decidedly don't do that because I personally think it's a kind of a silly exercise. I don't have the slightest idea what the market is going to do tomorrow, let alone where I think it's going to close on December 31st, 2015. And I think it's an exercise as much to have strategists and analysts pitted against one another. He was great. She was terrible.
Right.
And I'm not so sure the message that's being imparted helps the individual investor all that much. I think discipline and everything that goes with it, diversification, It's boring to talk about on TV. It's not headline grabbing, but that's what matters most.
Yeah, and again, I'm not necessarily trying to diss. I do feel like this is the direction that it's gone into, but now at this point, I think it hurts everyone involved, including the analyst and the individual investor. Thanks a lot, Liz Ann. Really appreciate it.